I'll now introduce our speaker for today. I'm very excited to be having with us my colleague, Arthur Gervais, who is a lecturer or assistant professor equivalent at Imperial College London. Arthur has been working on blockchain-related topics and decentralized systems for quite some time now, since almost a decade. So we're very happy to have him with us today to be giving a talk about one of our recently accepted papers at IEEE S&P. With that being said, Arthur, I'm going to pass it over to you.
Thank you very much, Satiris, for this warm intro. Thanks. So today we'll be speaking about high-frequency trading on decentralized on-chain exchanges. This is work with my hardworking PhD students, Lee, Kahua, as well as with Christoph and Duc. So some of you may know what a blockchain is, right? A blockchain is a distributed database. It allows the atomic settlement of financial transactions, and it's mostly built out of a few layers. I'm ignoring here the hardware layer and starting basically on the bottom with the network layer. That's an asynchronous peer-to-peer layer where information about transaction is propagated. Then on top of this, there's a blockchain consensus layer where you append a state change in each block. And on top of this, you can think of having an application layer where you can have smart contract enabled applications. And this application layer gave fruition to a wide variety of decentralized financial services. And some of them are the exchange of assets, the borrowing and lending markets, market making, stablecoins, and many others. What's interesting is that all these services, they kind of rely on rather common and community-wide adopted asset standards. So every blockchain typically has a native coin. There are fungible tokens and non-fungible tokens. And because of these standards, all these protocols are kind of like intertwined, which is quite an interesting property. As in traditional finance, in decentralized finance, we have a variety of market mechanisms. For example, arbitrage is typically considered a benign practice of equilibrating prices of assets on different markets. There are liquidations, there are governance votes, and security deposits or collateral. And just like in traditional finance, speaking of security, there are a lot of very smart and talented people coming up with novel market manipulation techniques, right? So these are, for example, front or back running, pump and dump, and many others. So the talk today will be mostly focusing on front and back running market manipulations. So I hope to have given you kind of a good overview here of where we are in the DeFi space. Now you might ask, why do we need a decentralized exchange? What's the point? Why don't we just use like a centralized exchange as we've done for decades? Well, if you ask Alice, who is rich, she may want to provide some of her money to traders to earn fees, right? So she wants to have her capital working for her, but she doesn't want to trust anyone. She doesn't want to trust a broker. She doesn't want to trust a bank to hold and manage her assets. On the other side, we have Bob, who is a nifty trader. And similar, he has a need. He wants to buy coins, the latest coins, and trade on a daily basis. But he struggles to find a trusted source to buy those assets, those new assets that just hit the market. And decentralized exchanges can bring those two parties together without a trusted intermediary. So let's look at a bit more technical view of what a DEX or decentralized exchange is. So in essence, a DEX is a smart contract application. So all the rules that this contract should abide by are encoded in an open source smart contract. You can verify that this code is actually operating on chain. So if you interact with it, you're sure that your money is abiding by the rules of this public smart contract. A few traditional exchange techniques are the price discovery. So if you have two assets, an asset X and an asset Y, what is the relationship of those assets? What's the ratio? What's the price ratio between those two? Right? That's price discovery. So the smart contract can discover this. You can match trades. So if Alice wants to buy a certain quantity of the asset X for a certain quantity of the asset Y, she can do so. And finally, the trade can also be cleared. So that's in traditional exchanges, it's a separate process. Here in the smart contracts, kind of all included in one go. So the trade clearing also happens in the smart contract of the underlying blockchain. So if you look at existing DEX trading volume, this has grown quite significantly, especially here in the year 2021. So we have reached peak monthly trading volumes beyond 60 billion US dollar. And you can see here that the daily volumes of DEXs is hit basically 3.5 billion US dollar compared to 50 of Binance, which is a centralized crypto exchange, and the Nasdaq, which is traditional stock exchange. So basically the DEX volume is still small, but it starts to be comparable to traditional finance. And so one little note I would like to make is that the volume that is displayed here is likely the true trading volume, because making a swap on a blockchain costs transaction fees, hence it's not free. So it's not that simple to create artificial trading volume, which is typically called wash trading. So wash trading on centralized exchanges is typically much cheaper for the centralized entity because there are no fees per se to create a transaction. So in order to understand high frequency trading in the decentralized peer-to-peer setting, we must look at the peer-to-peer network. So in the transaction propagation of a peer-to-peer network, we have a trader who is typically creating a transaction, for example, with a transaction fee of 5. Let's assume this is some monetary value. He's willing to pay 5 as a transaction fee. This transaction fee is then propagated. This transaction is propagated across different nodes worldwide. And eventually it's actually arriving at a miner. A miner is an entity that accumulates transactions and then writes them into the blockchain eventually. So let's assume here this miner receives this transaction, and the miner has a list of pending transactions, which are recorded in the mempool. So there are currently 2 transactions. The new one is added, and now we have 3 transactions in the mempool. And once the miner creates a block, you can see that the order here is preserved. So typically, because miners are rational entities, for the most part, they order transactions according to the transaction fee price, right? So the highest price gets the first position, etc. Now, how can this process kind of be abused by an adversary? So let's assume we have an attacker who is operating a so-called spy node. Spy meaning a node that's basically connected to as many peers as possible, with the goal to receive data as early as possible. So if we have a victim trader here who is issuing a transaction, sending to this blockchain peer, then we have an adversary who has a spy node also connected to this peer. And the adversary will now listen to the network and see, okay, there's a transaction that's paying a value of 5 for the fees. So why don't I front run this transaction with a transaction that pays a slightly higher fee, so that when it eventually hits the miner and the miner's pending transaction queue, I'm actually one position before this particular victim transaction. And naturally, as an adversary, I hope that I'm then also one position earlier in the block, in the final block. So I might need to make a note that the execution, so if there's a smart contract execution, the smart contract execution follows the order of the transactions here in the block. Okay, so this was front running. At the same time, we can do the same with back running. So you see, I just swapped here the positions of those two, right? So the adversary created a transaction with the same fee as the victim, but sent it out a little later. And because of that, the most commonly used mining softwares and blockchain clients typically order transactions according to the gas price, and according to the time of reception. So if you receive 2 transactions with the same fee, then the first is basically the first come first served principle. Okay, and this allows an adversary to control quite on a fine-grained level where to position a transaction before or after a victim transaction. All right, so we know a bit now about the ability to manipulate positions. Let's still dive a bit deeper into the background of automated market maker, which are basically the core components of nowadays DEXs. So an automated market maker, in essence, is a pool of liquidity. When you hear the word liquidity, it's nothing like wet or whatever. It's a financial term for money. So Alice here, for example, adds liquidity for asset X and asset Y to a particular pool, right? And this pool is governed by a smart contract. When I say governed by a smart contract, meaning that the money in this pool can only be added or removed from the pool by following the rules encoded in the smart contract. And we have Bob here. He is, for example, providing an asset X in return for an asset Y. And he's also paying a small fee for Alice. So he's the trader. She's the liquidity provider. Now, the most prevalent automated market makers, and also the simplest, is a constant product market making. So the common rule is we have an asset X and we have an asset Y, and we have the quantity small x and the quantity small y, which should always be equivalent to a constant K. So this particular formula allows us to have instant liquidity. This means we can immediately, whenever we basically provide asset X or asset Y to the AMM, we receive a corresponding asset X or Y in return, right? We don't have to wait for anybody, any market participant to kind of be ready to exchange the certain amount. And this is irrespective of the trade size. So that's quite an interesting property. However, the price will significantly be changed or depends significantly on the quantity that you want to trade. So on how many assets you want to trade. And naturally, if you purchase asset X, it will increase the price of the asset X in this particular smart contract pool. And if it will decrease the price of the other asset Y. So in this talk, we are only focusing on pools with 2 assets, right? There are also some proposals for having pools with several assets, but these are the most, I think 90% of the market or even more are actually only pools with 2 assets. So in the end, the ratio of the asset X and Y sets the price in an AMM. If you draw this on a chart here, you can see on the X-axis, we have the amount X of asset X in the pool. And on the Y-axis, you have the amount Y of the asset Y in the pool. And let's assume we have a given state. So we have 30 coins of the asset Y, and we have 10 coins of the asset X in the pool. So if we just follow the product, the constant product formula, well, that means that the K is equal to 300, right? So the state is 1030. And if we now want to change the state, so let's say we will add plus 5x to the state, right? Can anybody tell me how this will change the state?
Y will become 20.
Okay, and X? That's the easier one, actually.
15.
Exactly. Very good, right? So in this particular case, the state after, we basically provided 5x to the pool, and in return, we removed 10y from the pool. So we swapped 5x for 20y, because we always have to abide by this constant k to be 300 in this particular case. Right? So you can see here, this is the liquidity that moved down here and up here, right? So you kind of have this curve here on the, so this is actually called a bonding curve, and you you move the price on the bonding curve towards this point. Very good. So there's something, there's some like a technical concept called the expected slippage. So the expected slippage is the expected increase or decrease in price based on the trading volume and available liquidity. Sounds a bit fancy, but it's basically what we just looked at, right? You go from one state here to another state here. And there's obviously, because you move across along this bonding curve, there's a change in price. And this is basically the expected slippage. Because you know the formula of the pool, because you know the liquidity of the pool and your input parameters, you can calculate how much slippage you're expecting, right? So this is known. There's, however, another concept, which is called the unexpected slippage. And this now starts to tie basically the peer-to-peer part of our presentation to the AMM part. So now we have here two transactions. We have a transaction TC and you have a transaction TD. So TC is the transaction from the victim. TD could be the transaction from an adversary. So in essence, the point in time at which you execute the transaction, right? You don't know exactly where on the bonding curve you will start. Does anybody know why that is? Why don't you know exactly at what point in time you will start the execution? If you think about the order of transaction in the peer-to-peer network.
Because you don't know when your order arrives.
Arrives where?
Well, at the smart contract, because it's like a network.
Correct. So you don't know at what point in time, or yeah, you don't know at what position a miner will mine your transaction, and therefore you're not certain about the state at which your transaction will execute. Right? Very well. Perfectly fine. Yeah, very, very well said. So so you might get a worse execution price, but actually you might also get lucky. Sometimes you get a better execution price. So it's kind of like you don't really know what's the state what's the resulting state. So to protect yourself, there's a concept called the slippage protection. It's kind of similar to a limit order in the traditional finance. If you have an order book, you can say, I want to purchase this X asset at this price, right? So it's kind of like you set a limit. Here it's also a limit, but it's a bit a different limit because you allow for some slack, but not too much. So it's a configurable slippage protection threshold that the user can configure on the interface. So Uniswap, for example, after we disclosed our work to them in November 2020, they tightened their default slippage protection on their interface. So you can go on the Uniswap website, which is an AMM, and there is a slippage protection parameter. Okay, so what happens if you go beyond that slippage protection? Well, it's quite simple. Then this transaction fails, right? This one will just not execute. So the smart contract will honor your request that you don't want to pay more than this particular protection limit, and then it will revert. So this means your assets will not be taken, your swap will not happen. Great. So I think we have all the basics now to really understand sandwich attacks. Has anybody an idea why they're called sandwich attacks? It's delicious sandwiches.
Because they're so delicious.
Exactly. They're really tasty. Exactly. They're really tasty. I mean, the main message is because you have a victim that you squeeze between one adversary and another adversary transaction. So you can kind of think of building a sandwich, right? So there's a transaction one that you put in front of a transaction V, and a transaction A2 that you put behind a transaction V2. So the crux or the tricky part for an adversary here is that you should only push the victim so much that you don't hit the slippage protection, right? If it goes beyond, well, then transaction V fails, and you don't want to go that far. So it has to be a carefully calculated duo of transactions that kind of match, that squeezes them inside of a tasty sandwich. If you look at another kind of representation, so if you have a block n here, and the block n plus k here, and on the x-axis you have the time appearance on the blockchain peer-to-peer network, then we have a victim transaction coming here, and then two adversarial transactions, and you can see we're switching here orders, right? So we are squeezing it in between the two. So this is the victim, and this is adversary 1, and this is adversary 2. Fair enough. So how does this system look like from a technical perspective? So that's a high-level system diagram. Let me walk you through it carefully. So at first we have a victim, right? The victim sends a transaction to its node. So for example, this could be you going onto Uniswap website, you have a MetaMask installed and you click on swap on Uniswap. Then your MetaMask will send your transaction to your closest Ethereum node, for example, Infura, and you broadcast this in the Ethereum peer-to-peer network. At this stage, the adversary has a spy node, so he's receiving the transaction rather early. He's observing the victim, and then he's calculating, should I attack? Is it profitable? Is it profitable for me to attack? If it is, then he creates two transactions, TA1, A2, broadcasts this in the network, and eventually it gets picked up by some miners. And if the adversary is lucky or the victim is unlucky, then they get included in the respective state. Right? So that's kind of the sandwich system diagram. So if we look at a particular market, so here this chart is looking at the particular exchange market of the ETH-SAI assets. It's the market on Uniswap, and it's given at a certain block height. So it's a pass block on the Ethereum blockchain. So if you look at the x-axis, we can see here, this is the ETH transacted by the victim, right? So that's the victim amount. And on the y-axis, we have the ETH transacted by the adversary, right? So now let's assume that the victim makes a transaction of 30 Ether. Okay, so then we are basically on this particular line here. So the difference between the green and the red content is that the green side is where the adversary realizes a profit or the victim realizes a loss. And the red side here is where the adversary realizes a loss. So from the perspective of an adversary, we want to be on the green side. Now, if the victim set a slippage limit that is rather flexible, let's say 1%, right? Then we could basically go up to here, this point on this chart, to extract value from the victim. So that's if you look at the color, I mean, this is roughly around here, right? So it would probably be a few $100. So that's not little money, right? So certainly there are a lot of possibilities for adversaries to extract value from victims in that way. But what's more conceptually interesting from this particular chart here is that you can find some values where it's actually not profitable for an adversary to attack, right? So whenever you're in this realm, from a victim perspective, you're safe. Nobody will sandwich you. So, and as such, we came up with this concept of a minimum profitable victim input. So when you are in a certain realm, maybe roughly around here, so maybe if you don't exceed, let's say 20 Ether, then you're safe, right? And so this brings us to the possible mitigations. So we were lucky that fellow researchers at ETH Zurich implemented a mitigation technique to swap on Uniswap version 2. And the idea is basically to split the trade into 5 smaller trades to take advantage of this minimum victim input, right? So the disadvantage of doing so is naturally that you have higher transaction fees because you do now 5 swaps instead of 1 swap. But each of these 5 swaps individually are safe from sandwich attacks by an adversary. Any questions so far?
See
Okay.
any in the chat or the live stream, so you can continue after.
Okay, perfect. And that's it. we're end of the talk, and I'm happy to take any of your questions. I've included some of the details of the paper. So for example, we've considered also multiple adversaries, yeah, we're happy to discuss those in the questions, or if you want full details, you can find them in the paper.
So as everyone is warming up, maybe I can ask a little bit more general question. Are the sandwich attacks the only kind of attacks we should be worried about in these kind of exchanges? And so if you were to kind of rank them by their impact, what would that be? I've seen you've already shown that you know, this can cost in the orders of hundreds, maybe thousands of dollars if you manage to mount under some assumptions those attacks. Are there other kinds of attacks we should be worried about?
In general, so this is actually so this is actually quite relevant to one of my back slides, which is an alternative method to do sandwich attacks. So I only showed you one particular method, but you have basically other methods of doing sandwich attacks. So for example, if you're a liquidity provider, you can add liquidity or remove liquidity. So it's a bit more complicated, as in as an adversary, you have to perform three adversarial transactions. So it's less likely to succeed in this order. But there are certainly more advanced so-called sandwich attacks that can happen. Besides sandwich attacks, I wouldn't want to say that these are the only attacks. I mean, there's certainly other types of attacks that happen in decentralized exchanges. Then it's always tricky. Do you call them attacks or features of the protocol, right? Like arbitrage, for instance, it's something very natural in traditional finance. But in some cases, if you front run somebody or back run somebody to perform arbitrage, is this then an attack, or is this still like benign trading? So there's always a bit of a gray line, and I think the security community has naturally difficulties in classifying them as bugs or features, right?
Mm-hmm. Thank you for that, Arthur. We have a couple of questions queued up. Let's start with Mark Ryan. If you want to ask your question live, more than welcome to do so.
Thank you. Well, first, thank you for a very interesting talk and a very educational talk, because speaking for myself, I didn't know much about this, so I'm very grateful for the kind of slow pace and the pauses and everything that you included in your talk. If I may ask a question, it would be just about the slide that you showed with the red and the green. If we could just go to that slide.
This one?
Yes, that one. Just a few questions about that, if I may. First of all, the 9M, it says block 9M at the top. Is that 9 million? So is that like the 9 millionth block? Or what?
That's correct. Yeah,
okay.
It basically corresponds to a date, date and time.
So that's a bit, you just chose an arbitrary block. Obviously, there's nothing particularly special about the 9 millionth block. That's
correct. Yeah, right. It's basically a timestamp. Yeah.
Okay, thank you. And then I just wanted to understand, I mean, this kind of trade-off with transaction fees. So it looks like the smaller the transaction fees are, the more opportunities for the attacker to do this kind of thing. Is that correct?
Very well observed, yes. So we have here two break-even thresholds for the adversary. So if the adversary breaks even earlier, then he gets more profit, and that's mostly due to the fact that he has to create two transactions to exploit a victim. So the higher the transaction fees, the more overhead he has, in a sense, right? So you can see here, this is, if we look at this plot, is kind of this difference, which is caused by the transaction fees in this particular example.
Mm-hmm. I see. So that means that when we move to proof of stake and hopefully transaction fees go down, this problem will certainly not go away. In fact, it will get worse because lower transaction fees are better for the attacker.
if proof of stake does provide lower transaction fees, then yes, lower transaction fees are in that sense worse.
Right.
I mean, we have created in my research group, we have created a new protocol that allows you to perform kind of atomic routing and swaps across multiple exchanges within one transaction. And if you have lower transaction fees there, then it kind of protects you more. But because you can create complex routing and arbitrage across multiple exchanges. But if you just look at one exchange in isolation, you're right. Right? Then it would be kind of worse for the user.
Right, I see. So, what countermeasures do you have for this attack? Insofar as you said, it might not be considered an attack because of might just be considered a feature. But if we consider it as an attack, then what countermeasures would we have?
So there are actually a few countermeasures currently proposed. Let me systematize them very quickly. So the one is basically you tell the user to split your trades and considering this minimum victim input, right? So that's this solution here, which increases your transaction fees, but it splits it into multiple transactions, right?
Right.
So that would be one countermeasure. So let's assume this is number one. The second countermeasure is if you have now, let's say you have a trade that comes in, so there's a transaction, and then you have one AMM. So let's say this is AMM1, and then you have another AMM. This is AMM2. The countermeasure would be that you split the trade into those two, and you send it actually to these two exchanges. And if necessary, you still do arbitrage among those two. And all this within a single transaction, within a single atomic transaction, right? This is possible because you can just code it up in a smart contract. So all this is a single atomic transaction. So now an adversary would need to, the process of performing a sandwich attack among two AMMs would be much more complicated for an adversary and possibly less successful. So if the success rate of the adversary diminishes, the security of the user increases. Right?
Yes,
so,
but you paid twice the transaction fees again, don't you? Because you pay for both AMMs.
At the minimum, exactly. Yeah. In this particular example, but you do take advantage of the minimum viable input, minimum victim input, and you do take advantage of the different prices on the AMMs. So the user is in expectation actually receives a better price than just trading on one exchange, because your aggregated liquidity, so you aggregate the liquidity of those two exchanges as if it were one exchange. So the price that you receive is in expectation better than swapping on one exchange. Hence, it's true that it depends a bit on your trade size, right? Hence, you might arbitrage the transaction fees.
I see. Final question, if I may. What's the current status of these attacks and the other ones that are currently in IEEE S&P this year? Like, are there people actively exploiting them? Can we all, after this seminar, go to our laptops and start exploiting them, or will we be prevented? Are people actually actively doing these countermeasures that you describe?
People are being actively exploited, so it's quite a let's say it's a bad state at the moment for users, I would say. Quickly sharing here my screen. We quantified this in this other paper. So you're basically asking how dark is this environment, and here we quantified that I think sandwich attacks. We have sandwich attacks are about, let me find the numbers roughly, but it's several millions basically are extracted through sandwich attacks. Here for sandwich attacks, we identified total profit of 1.5 million in this particular measurement study here.
What is the period over which this is?
I think this must be 2 years, yeah, but I'm not exactly sure. We need to double check. Yeah, I mean, most
That's
of the
actually
values
still small potatoes, right? So there was somewhere this much in 2 years.
Right. I mean, we have certain assumptions, certain metrics, so they might obviously have false negatives because we don't have access to ground truth, but the extractable value from liquidations is certainly higher than from sandwich attacks, it seems, and arbitrage as well is significantly higher.
Thank you.
All right. Next, may I ask Philip Nuttler if you still have a question? You can go ahead and ask.
Yeah, hi. Thanks for the talk. Yeah, I think most of my questions have actually been asked by now. So the first one was actually, so yeah, I wanted to, how do you quantify the damage of the sandwich attacks, right? Compared to, for example, the volume damage of like flash loan attacks. Now that those happen quite often. Yeah. So like relatively to other attacks, what is the impact of this? That was the first question. Maybe you could.
Yeah, I would say relative to liquidation or arbitrage, I guess sandwich attacks are probably the smallest according to our empirical data. But the way you quantify it is that you can build up heuristics. So you can scan the past blockchain data, and you can say, if I see a transaction that has a slightly higher gas price, and I see a second transaction that has the same gas price, and they come from the same address, so they're basically squeezing a victim, then this is likely a sandwich. Now, the adversary could say, well, I might use just different addresses for the first and the second transaction, then it's harder to detect, but it's still, you can still kind of use some heuristics to classify them.
I see. Okay. And then maybe one more question. Did you relate that only to Ethereum or like also other blockchains such as Binance Smart Chain, for example?
Yeah, that's an excellent question. So our empirical data currently only touches Ethereum because it's a rather open network, but Binance Smart Chain would be quite interesting to look into because the network seems more centralized, especially the validator set. So that's future work.
Okay, cool. And maybe one last thing related to that, because we said that if the transaction fees are higher, you're less likely to be a victim of this attack. But like, how does it relate to like transaction speed in a network? So for example, Binance Smart Chain is cheaper, but as well faster. So if transactions are faster, would it be easier or harder to conduct a sandwich attack?
Yeah, that's an intriguing question because when you say faster, you mean the inter block time interval is smaller, right? So the frequency at which you update the state of the chain is smaller. It's faster basically. So the adversary still needs time to listen to your transaction and to react. So if he's not reacting quick enough, then he has no chance. So there's probably a sweet spot at which if the update is just happening too quickly, the adversary cannot answer, or the adversary basically needs a faster connection to the miners and to the victim, right? So in the end, it will be then how do you co-locate as efficiently as possible to those two entities, which the traditional finance people probably are well aware of how to do.
Some kind of optimization problem. We can come up with some kind of model for that.
Right.
All right, cool. Thank you very much.
Thank you.
So the next question is by Sanjay. I don't know if Sanjay wants to ask your question live. Otherwise, I'll repeat the question. Oh, there he is. Yeah. Go ahead,
I was not sure if I'm on the web, so whether the web client would have worked properly. So thanks for the talk. Very nice talk. Thoroughly enjoyed it. Learned a lot as Peter mentioned. So will randomizing the transactions on the block, I mean, when a miner, you mentioned that a rational miner would typically have it sorted. So why not just randomize it? And if that works, then maybe raising an EIP would probably be a solution.
So how do you ensure that? So how do you enforce randomization? Right. I think that's the question. Like, how do you punish somebody for not randomizing, right? For example, and because if you can't punish them, then they will not randomize it, right? Then they will just try to extract the maximum they can. And if they are kind of enforced to use some kind of a magical function that randomizes it, then as a miner, I would just call this function as often as possible so that I get randomly like a maximized revenue, right?
Sure, sure. Yeah, yeah. Okay, yeah, thanks.
Thank you, Sanjay. Changyu, you want to go next?
Yeah, thank you. Very interesting talk. So my first question is about the second transaction. I understand the first transaction is to squeeze the victim towards the threshold. Is the purpose of the second transaction trying to sell back and take profits?
Yes, very well understood. It's actually an exit transaction in a sense, right? You take a position by doing the first transaction, and then you don't hold on to the asset. You don't want to gamble on the value of the asset, and you exit. That's the
okay. Right. So my second question is: can the attacker be attacked?
Yes.
So because yes, you send the transaction, and then someone sees this transaction may be profitable, then they create another sandwich around your.
Yes, certainly. So that's definitely something that can happen. They can basically, the adversary can be squeezed into a sandwich as well. So the question is basically what kind of slippage do you want to set as an adversary, right? If you set the slippage very tight, your transactions are likely to fail as well, because there is likely that there will be other adversaries trying to attack. And we actually simulated this in the paper. So we can see here, the more adversaries there are, the harder it gets for an adversary to make any profit, right?
Right.
Yeah.
So my third question is actually about the success rate of the attack, because if you fail, you probably will lose something, and this will eventually affect the profits, the overall profits the adversary can get. So is there any data say how much, what is the probability the adversary can succeed? Because it's depends on many things, right? The ordering of the transaction, and also whether it's arrives to the miner as planned, and whether the miner actually take this order as planned. Because some of the miners, they don't care about the transaction fees. They actually take order just by some the sequence they see them sometimes.
Yeah, you have a very good intuition actually about this attack. So if you do attack in such a setting, your goal should be to fail as free as possible. So the cost of failing should be as low as possible. That should be minimized. Now, I'm not sure if we actually have data on the number of failures. I mean, we've seen a lot of failures. Maybe, I mean, Lee and Caillou actually in the call. If you know any quantitative data about failures, I don't think we did measure this systematically, but you may correct me if I'm wrong.
Okay. I guess I'll move on to the next question. So in the chat, Simon was asking, was this a theoretical attack or practical? And if practical, any estimate for the amount of money attackers raised, or I guess can raise?
These attacks are fairly practical. We have seen them. We have seen over a 2-year period, we identified about 1,400 independent addresses performing attacks. So these are basically number of adversaries at most, because an adversary can use several addresses at the same time if they want to. We measured total profit of about $1.5 million, if I recall correctly, over the span of 2 years. So this is actually not in the paper I presented. It's a measurement paper. It's a separate one that focuses only on measuring the actual impact, the real world impact of this attack. But I mean, this is happening every day, and there's even a website, I think it's called MEV Tax or something. I think I've seen a few websites that quantify. So if you do have So I have not tested this website, so please be careful. I'm not advertising here any application either, but I think they do quantify if you were a victim of a sandwich attack. So you can basically connect your wallet, and they will scan the blockchain for you and tell you how much money you lost through sandwich attacks, for instance. But there are also other attacks, other front-running or back-running attacks that might happen. Here, Lee just shared it, this sandwiched.vtf. Yeah. So because
right.
all this data is open, I mean, it's such a beautiful playing field for researchers, right? Because all this data is open, and you can just crawl the data and try to extract this knowledge.
Another question by Jan. Is it possible to identify such front runners by on-chain data alone? And if so, are there strategies to counter those adversarial traders in the span of one transactional block?
So to answer the first question, it's a good question, because indeed, if data is not written on chain, you will not be able to perceive it by just looking at on-chain data. So if the front-running transaction is included in the blockchain, then you can use that as a detection. You can use it. You can detect it, right? Given the right heuristics, etc. If however it's so, this is a practice that a lot of traders are doing nowadays. They're issuing transactions and then canceling them later or updating the transaction. And then the earlier versions are actually not written to the blockchain ledger. So I think we have seen like the overhead on the network layer to be sometimes you have 60 transactions that are being broadcasted, but only one is written to the ledger. So it depends a bit whether you look at front or back running, but we have seen quite stark amplifications on the network layer that you wouldn't actually perceive in the blockchain layer itself. So it's worth looking at both if you want to study this. And sorry, I forgot the second part of the question. Was it in the chat or Soteris? Oh, I think you're muted.
Sorry about that. Yeah, so that's a question by Jan called Botner. So it says, if it is possible to identify front runners by on-chain data alone, are there strategies to counter those adversarial traders, especially in the span of one transaction block?
So to counter them, I mean, the countermeasures I would resort basically to the two methods I described, right? So you have the minimum victim input. So if you split your trades, you minimize the likelihood that you get attacked because the volume is just too small to be profitable. You might use solutions that aggregate multiple DEXs that split the trades and do atomic routing. So the adversary would need to mount a more complex attack covering two exchanges. So basically, if the users get more sophisticated or such aggregators get more sophisticated, they can better protect the users in the end because the adversaries have to catch up. But I think it's more or less a cat and mouse game at the end of the day. And there's another solution. No, I think these are the main solution for users. Yeah.
Maybe it would be useful if you can share the paper with the atomic routing.
Of course.
Just to the benefit of the audience. I don't know if Ben wants to ask his question. I said on the chat, yeah.
Sure. So mine was slightly more high level in that. I mean, given that there are many sources of MEV, how does this one change the picture in some sense, right? I mean, given that like the number you quote for 2-year period is somewhat small in the grand scheme of things, does that really significantly change sort of the MEV landscape? So that's sort of number one. Number two is that, I mean, if you were to redesign an L1, and we've seen some people trying to redesign L1s, trying to prevent front running, would there be some provisions against this kind of possibility as well?
You mean by redesigning the blockchain from scratch, or?
Well, redesigning the consensus sort of layer essentially, right? So at least that, right? So there are trading chains like, for example, Vega, that attempt to implement front running somewhat. How successfully, I cannot tell. Certainly people have tried.
Right. So, I mean, there's certainly fundamental redesigns of the blockchain architecture that might prevent front running. So you could, for example, think of sealed auctions, right? So people have to provide a bid, and then they get batched at some point. So you can't really front run this batch easily. You can do delayed like commit and reveal protocols, but they have other drawbacks. You have to you will slow down basically the process. Now, I think Avalanche and the one you mentioned probably are claiming that they're more front running resilient. I haven't yet been able to understand why that is the case. So this is I would certainly encourage everyone to look into projects that are claiming to be MEV or front running resilient, because it's quite an interesting topic to work on, I find. We have just released here this A2MM paper. This is an application layer solution, so it is backward compatible with the current Ethereum chain, for instance. Doesn't require a change of the underlying consensus or network layer, but only addresses a sub section of the MEV, and is unlikely to capture all the MEV. So we kind of think it's good to have a mix of all these types of solutions to as a research community to avoid these market manipulations that are targeting everyday users.
Next, Mark, you had a follow-up. If not, maybe we can move on. I see Philip's hand raised. Is that from before, or is that a new question, Philip?
Sorry, I was muted. May I ask my question?
Yeah, please go ahead, Mark, and then we can circle back to Philip.
Thanks. I just wanted to go back to the fundamental issue, as Arthur mentioned it, which is the reordering that the miners do, because they want to maximize their transaction fees. So they order the transactions in descending order of transaction fees. However, I guess it occurred to me that they don't necessarily have to do that. They just want to select the top ones for their block, but they don't care about how they're ordered within the block, because what they're going to get is the sum of all the transaction fees for that block. It doesn't matter how they're ordered within the block, if I understand correctly. So it just struck me that is a difficulty for the attacker. The attacker can't rely on miners doing a full ordering. Miners will just do enough of an ordering to maximize their benefit, but they don't have to order it in strict descending order. Is that correct?
Fully right. Yes. So we performed. We tried to analyze how miners behave. I think we found that 80% of the blocks are actually following the full order.
Okay.
Yeah.
I suppose because sorting is cheap, you might as well just sort. It's the easy thing to do.
Right. But still 20% are somewhat different, right? Somewhat special.
Yeah, I see.
So, I mean, also a small note, I mean, we have seen the emergence of specialized ordering as a service providers. It's basically a centralized server that's receiving transactions from traders, and then the server has peering has peering agreements with miners, private peering agreements. So we've seen, unfortunately, quite a centralization of the peer-to-peer network, and I think this is really dangerous nowadays, because we want to have a decentralized network, and we don't want to have a central entity that can basically control, see everything that's happening, censor transactions, sell the data, etc. So that's why I feel like this topic is really, really important to kind of keep blockchains decentralized.
So how do you see that developing going forwards? I mean, it seems proof of work is necessarily going to be centralized because it's just a very expensive, capital expensive business to get into. You have to buy the rigs and everything. So there will be centralization, but maybe with proof of stake, things will be more decentralized, but maybe not because of the DPoS, distributed, sorry, what is DPoS standing for? delegated proof of stake. Yes.
Yeah.
So how do you see that going forwards?
Yeah, I think the underlying consensus mechanism, or however you elect a leader, or however you build the chain, is probably an orthogonal issue or challenge. But I don't think it will significantly change this type of MEV or value extraction through sandwich attacks or other means.
I see.
But it's hard to foresee the future. Yeah.
Mm-hmm. Thank you.
It's hard to foresee the future, but I think there's plenty of evidence that shows that POS is generally actually more centralized or easier to become centralized. Right? I mean, you only need to accumulate enough buying power. You don't need to build any rates.
Uh-huh.
So in some ways, it's worse.
Probably also because, I mean, it's easier to move around capital than to build up a mining farm, right? It's just more, you have to be much more invested. Yeah.
So I'll probably have 2 minutes left. Maybe I'll give you a chance to Philip, if you had a final question for Arthur.
Okay, if we only have 2 minutes, maybe it's just quickly, because you showed this, I wanted to discuss this L curve thing you had about the profit you make as a front runner, because I was wondering, like, who's getting actually, who are the most victims of these attacks, right? Because I think the ETH amount was quite high, like 10, 20. Does it mean if I'm like a retail user of those DeFi exchanges, will I be less likely targeted? Because it seems like the amount is quite high. I think, yeah, like it seems like if you go to below the 20 threshold, you're less likely to make a profit.
I think it mostly depends on the setting that you choose as a user, and how is the, I mean, and about the default setting of the UI that people are using, because most people probably, they don't actually know how to set the slippage, right? I mean, why 0.1? Why not 1? I mean, doesn't mean much to a user without explaining what's behind. And I mean, we haven't seen Uniswap, SushiSwap, or similar exchange to even explain or attempting to explain what it means in detail. So I think it would be, yeah. I'm sorry, I'm not sure if this answers your question.
Yeah, it's more like that's the quantity of Ethereum I use, the retail traders use, like alter the likelihood of being attacked. So it does, right? And it seems like it's rather high. So is it that more like whales are being attacked, to put it in simple terms?
I mean, this particular, yeah, it's maybe a bit misleading, this chart
from
here.
when is this, right? This must be fixed at some time point.
Yeah, exactly. It's basically because I fixed this, or we as a research group, we fixed this at a particular time point here. And it might be very different now, right? I mean, ideally we would need to actually have a website, or ideally whenever you go on Uniswap or a similar exchange, you type in the amount you want, and then the website tells you, just calculates based on the state, you're likely to be in front run now, right? Or maybe lower it by 5% and then you're safer, right? Or like, I think there's a lot that can be done on preventing users from being defrauded. Yeah.
Do you know roughly when this 9 million block was?
I think this was last summer. Let me check quickly. You can just go on Etherscan.
Yeah,
and then,
because 20 Ether is quite a lot of money to me, at least.
Of course.
Well, now it is. Used to be pocket change.
So 9 million was in November 2019.
Okay. So before
that's yeah, in November. That's about when we. This was actually in November 19 that we disclosed this to Uniswap as well, right? Yeah.
Okay. Then maybe last words. What is your take on the future of DeFi? Do you think it will replace centralized exchanges, at least on the blockchain, or what do you see the next 2 years happening?
I'm sorry to again provide a shameless plug to our latest paper, but so we have a paper that's called DeFi versus CeFi. Let me quickly show this here. So that's that one. It's comparing centralized to decentralized finance. I think they can both beautifully coexist and learn from each other, right? I think synergies are really possible here, and I think the transparency that blockchain can provide will help traditional finance to become maybe more transparent, whereas the regulation and the user protection that traditional finance provides will hopefully somehow be translated to DeFi so that users get less defrauded. But who knows?
This is a great note to bring this seminar to an end. Again, thank you very much, Arthur, for joining us today and sharing your work with us. Thanks to everyone who have attended either live on Zoom or on YouTube. Please do check the UK SPS website for upcoming seminars. We are inviting a lot of speakers. If there is someone in particular that you would like to hear from, let us know and we'll do our best to invite them. And with that, I'd like to wish you to enjoy the rest of your day. And thanks again, Arthur, for
thanks a lot, everyone.
invitation.
This was amazing questions.